So coming to the second part of amalgamation. In this session, we are going to discuss two things. One is accounting in the books of transferor and accounting in the books of transferee company. In the previous session, already I told you, AS 14 is applied only in the books of transferee company. In the books of transferor company, AS 14 is not applied. Simply we write dissolution entries in the books of transferor company. Okay, let's we start with accounting in the books of transferee company. So, and nothing but we do the accounting as per AS 14. As per AS 14, amalgamation is classified into the two types. And one is amalgamation by measure and amalgamation by purchase. And when we said that amalgamation is by measure or amalgamation in the nature of purchase, and depending upon five conditions are stated as per the standard, if these all five conditions are satisfied, then that is said to be a amalgamation in the nature of a measure. If any one of the condition or all the conditions are not satisfied, that is said to be a amalgamation in the nature of purchase. What are those five conditions? And remember, first one, all assets and liabilities of transferor company should become the assets and liabilities of transferee company. All assets and liabilities, and also remember, including reserves and surplus. All assets and liabilities of transferor company should become the assets and liabilities of transferee company. And the second one is the shareholders holding not less than 90% of the face value of equity shares of transferor company should become the shareholders of transferee company. So shareholders of transferor company holding not less than 90% of the face value of equity share should become the shareholders of transferee company. Should become the shareholders of transferee company. Third one. And purchase consideration should be paid by transferee company only in terms of equity shares of transferee company only. Only in terms of equity share. But if any fractional number of shares we have, and that will be paid in terms of cash. So total consideration should be payable only, it should be received by the transferor company, should be received by the transferor company in terms of equity shares of transferee company, unless there is a fractional number of shares. If any fractional number of shares we have, that will be settled in terms of what? Cash payment. And the business of transferee company should be continued in the name of, sorry, the business of transferor company. The business of transferor company should be continued in the name of what? Transferee company. The business of transferor company should be continued in the name of transferee company. And the last one, while transferring assets and liabilities of transferor to the transferee, don't make any adjustment. All assets and liabilities should be transferred at book value only. Should be transferred at book value only. But if anything is done, and if because of uniformity of accounting policy, you may do the changes. So for getting the uniformity in accounting policy, you may do the changes. Okay. So five conditions we have which are required to be satisfied for verifying the amalgamation in the nature of measure or purchase. If all the five conditions are satisfied, then that amalgamation is treated as amalgamation in the nature of a measure. If any one of the condition or all the conditions are not satisfied, that is treated as amalgamation in the nature of a purchase. Amalgamation in the nature of purchase. So 1 minute. Okay. So this is what amalgamation in the nature of measure and amalgamation in the nature of purchase. And this classification is provided by AS 14. Okay. AS 14. So if these all five conditions are satisfied, we treated that as amalgamation in the nature of measure. So what are those five conditions? Just repeat it. All assets and liabilities, including reserves and surplus of transferor company, should become assets and liabilities of transferee company. Second one, shareholders of transferor company holding not less than 90% of the face value of equity share should become shareholders of transferee company. And third one, purchase consideration should be receivable in terms of equity shares of transferee company only. If any fractional number of shares are there, we will get cash payment and transferor company will get cash payment. Fourth one, the business of transferor company should be continued in the name of transferee company. And the last one, all assets and liabilities of transferor company should be transferred to transferee company at their book value unless there is for example, if any accounting policies are changed for bringing the uniformity in accounting policy, you may change the book value. Okay, so these are the points. If all five conditions are satisfied, that is amalgamation in the nature of measure. If any one of the condition or all conditions are not satisfied, that is in the nature of purchase. Next one. And coming to this. And in case of amalgamation, in the nature of measure, we follow pooling of interest method. In case of purchase, we follow purchase method. And what are the accounting we have done in case of pooling of interest method? In case of pooling of interest method, simply not only the assets and liabilities, but also interest of the shareholder is also pooled together. Interest of shareholder is also pooled together. Okay. First one, in case of pooling of interest method, first point is what? All assets and liabilities of transferor company should be transferred at what? Book value only. Because in the measure, no adjustment is allowed. But in case of purchase method, all assets and liabilities are transferred at fair value or at agreed value. If anything is provided at agreed value, we have to transfer. Second one, reserves and surplus. And remember, in case of pooling of interest method or in case of measure, all assets and liabilities, including reserves and surplus of transferor company, should be transferred to the transferee company. Should be transferred to transferee company. So assets also transferred, liabilities also transferred, including reserves and surplus are also transferred. Also transferred. But in case of a purchase method, remember reserves and surplus not transferred except what statutory reserve and those reserves which are required to be maintained as per a law or as per a particular statute, and that is called as statutory reserve. So for example, investment allowance reserve is there. As per the IT Act, it has to be maintained for 5 years. But for example, transferor company already maintained 2 years. The remaining 3 years required to be maintained by transferee company. Transferee company. In that case, statutory reserve is incorporated in the books of a transferee company under purchase method. So only statutory reserves are incorporated, other reserves are not incorporated. But after completion, at the time of incorporation, we write simply what? Amalgamation adjustment account divided to statutory reserve. And after completion of that year, that period, say the remaining 3 years, we have to reverse that entry. Statutory reserve account divided to amalgamation adjustment. And amalgamation adjustment account is shown as a reduction from total reserves and surplus in transferring company. Total reserves and surplus. Next, coming to the adjustment. This is very, very important. In case of pooling of interest method, in case of pooling of interest method, you have to check the difference between purchase consideration, difference between purchase consideration and share capital of transferor company. Purchase consideration is compared with share capital of transferor company. If the difference is under nothing but what? For example, transferor company share capital is say 10 lakhs. Say 10 lakhs. You are paying the PC of 15 lakhs and you are paying more. You are paying more. If the PC is more than his PC is more than 15, more than share capital, nothing but if it is a positive that is a capital loss. If it is a negative, that is the capital profit. Capital profit transferred to capital reserve. Capital profit transferred to capital reserve. But if it is a capital loss, adjust to the reserves of transferor while incorporating in the books of transfer. Adjust to the reserves and surplus of the transferor while incorporating in the books of transfer. And the reserves and surplus, first we have to adjust it to general reserve, reduce it from general reserve of transferor. And if any surplus is there, and reduce it from profit and loss account of the transferor. Profit and loss account of the transfer. And but coming to the purchase method, the PC is compared with net assets of transferor. If it is a positive, same way capital loss and is transferred to goodwill. But if it is a negative, same way that is a capital profit and transferred to capital reserve account. Capital reserve account. Understood? So in case of amalgamation in the nature of measure, purchase consideration is compared with share capital of transferor company. In case of amalgamation in the nature of purchase consideration is compared with net assets of transferor company. Net assets of transferor company. Okay. So this is the one. And then we'll discuss what are the entries. And the same what we discussed here in the form of entries we discuss. And first, what are the journal entries to be recorded in the books of transferee? For purchase consideration, so means here we are acquiring the business. We are acquiring the business. In return, we pay the required to pay the amount to the transferor company, shareholders of transferor company. And what we required to pay? Nothing but what PC. So first we have to write the entry for PC due. What we get? Business. So we write the entry business purchase account debited to liquidator of transferor company. Liquidator of transferor company. In both methods, we have to write same entry. And second one, for incorporation of assets and liability. What we get in case of pooling of interest method, we are getting what? Assets, liabilities, reserves and surplus. So, and in case of purchase method, we are getting assets and liabilities only at agreed prices and agreed assets and liabilities only we are getting. So, in case of pooling of interest method, assets account debited, 2 liabilities, 2 reserves and surplus, 2 business purchase. In case of if it is a capital profit, then it is credited to capital reserve. And if it is a capital loss, that is adjusted to reserves and surplus of transferor company. Reserves and surplus of transferor company. If the reserves and surplus of transferor companies are not sufficient and is debited to reserves and surplus of transferee company account. Transferee company account. If the PC is more than net asset, more than share capital. Here PC is more than share capital, then the difference is treated as capital loss and is adjusted to what? Reserves and surplus of transferor company first. In that, first general reserve. General reserve of transferor company. Second one, general reserve of transferee company. Third one, profit and loss account of transferor company. Next, profit and loss account of transferee company. This is the order generally followed. So, general reserve of transferor company and general reserve of transferee company. Profit and loss account of transferor, profit and loss account of transferee. If any reserves and surplus of transferee company was adjusted, those are debited here. Those are debited here. But in case of capital profit, simply credited to capital reserve. And coming to the purchase method. And while incorporating assets and liabilities, we have to write the entry. So what is the entry? Assets account debited, 2 liabilities, 2 business purchase. If any capital loss, that is debited to goodwill. If any capital profit, that is credited to what? Capital reserve. And next one, for incorporation of statutory reserve. And remember, in case of amalgamation in the nature of measure, this is not required because all reserves and surplus are incorporated. And statutory reserve specifically incorporated only in case of purchase method. Amalgamation adjustment account debited to statutory reserve account. Amalgamation adjustment account debited to statutory reserve. And for settlement of PC. And the PC is required to be settled to what? Liquidator or purchasing company. And liquid in what form we are paying? Either in terms of cash, or in terms of equity share, in terms of preference shares, or in terms of debentures also. So liquidator of purchasing company account debited, liquidator of transferor company account debited to cash or to bank, to equity share capital, to preference share capital, to debentures, to security premium, to bonds if any. And in case of purchase method also same thing. And if any liquidation expenses paid by purchasing company, the purchasing company is paying the liquidation expense. In case of merger, that is adjusted to either goodwill or capital reserve. In case of a purchase method, that is adjusted to profit and loss account. Profit and loss. Goodwill or capital reserve account debited to cash or bank. Here, profit and loss account debited to cash or bank. For elimination of corporate owing, for example, if any intercorporate owings are there, and just like what we discussed in case of consolidation, and any intercorporate owings in between them, and one item is available on asset, one item is on liability, and both are of same nature, same amount. So that's why we have to reduce it from liabilities as well as from assets. So liability account debited to assets account. And another most important thing is elimination of stock reserve. And what is meant by stock reserve? Generally, stock reserve stands for what? And any unrealized profits we have. And for example, if the transferor company sold goods to transferee company, transferor company sold goods to transferee company at a profit, at the profit, and any unsold stock lying with transferee company, any unsold stock lying with transferee company. So in that case, on that unsold stock, we have to eliminate what? Stock reserve. Or in case if transferee company sold goods at profit to transferor company, and some unsold goods are lying with transferor company, in that case also we have to eliminate what? Loading. Or we have to eliminate what? Unrealized profit or stock reserve. And remember, stock reserve is always lying with selling company. So unrealized profits are always lying with selling company, and also we require to adjust it in stock account. And what is the adjusting entry to be recorded? In case of purchasing company, in case of amalgamation in the nature of merger, simply we write goodwill or capital reserve account debited to stock reserve. In case of amalgamation in the nature of merger, sorry, in nature of purchase, profit and loss account debited to stock reserve. And the stock reserve is required to be shown as a reduction from the stock, as a reduction from the stock. Okay. And these are the journal entries we have to record in case of purchase, in case of measure method, and means pooling of interest method. Okay. So for example, sir, in the problem, what is the nature of the method is not specified. Then simply follow amalgamation in the nature of purchase. Follow purchase method only. Follow purchase method. Okay. So then coming to the problem. So consider the following balance sheets of Excel Limited and Y Limited. And here two balance sheets are provided. And here Excel Limited take over Y Limited. And Excel Limited is the transferee company. Y Limited is the transferor company. And the Excel Limited discharge the PC as follows. So what is the PC condition? And remember, while doing the problems in case of amalgamation, the first step you need to calculate what is the purchase consideration. What is the purchase consideration is very, very important. So issued 3,50,000 equity shares of 10 each at par, and it means to the equity shareholders. So 3,50,000 into 10, 35 lakhs, and to the preference shareholders. So to discharge preference shareholders at 10% premium, 10% premium. What is the preference shareholders we have? And here the preference shareholders of Y Limited is 17 lakhs. Preference shareholders of Y Limited is 17 lakh. That means total 17 lakh plus 10%. 18 lakh 70,000. 18 lakh 70,000. Then here what is the PC? Purchase consideration is 53 lakh 70,000. And the debentures of I Limited are converted into equivalent number of debentures of X Limited. Statutory reserve of I Limited are to be maintained for 2 more years. 2 more years. And show the journal entries and the balance sheet. So here what is the PC? 53 lakh 70,000. Okay, first we'll verify the PC here. So here is the PC. PC calculations. Hmm. So first the PC calculation here. What is the PC they computed? 53 lakh 70,000. 53 lakh 70,000. And first in the nature of measure, what are the entries? What are the entries? First we have to record. So for purchase of the for purchase consideration due. Business purchase account debited to liquidator of I Limited 53 lakh 70,000. And second one for incorporation of assets and liabilities including reserves and surplus. And here before that we have to calculate difference between purchase consideration and share capital of transferor company. What is the share capital here? 47 lakhs. 47 lakh. Here, so PC minus share capital. 53 lakh 70,000 minus 47 lakhs equal to, minute, sorry, 6 lakh 70,000. 6 lakh 70,000 is required to be adjusted as part of amalgamation in the nature of measure. And where to adjust. So in case of a measure, nothing but pooling of interest method, we have to reduce it from general reserve of transferor company or general reserve of transferee company or profit and loss of transferor, profit and loss of transferee. This is the order. So here PC is more than share capital. So it is a capital loss. We have to adjust it to general reserve. And what is the general reserve of transferor company? 2,50,000. First, we have to adjust it here. 2,50,000 will rate. If general reserve transfer or company is closed, out of 6 lakh 70, 2 lakh 70,000 is there. So 6 lakh 70, 2 lakh 50,000 is closed, and 4 lakh 20,000. That 4 lakh 20,000 is debited to general reserve of X Limited. General reserve of X Limited. And the remaining or each and everything we have to carry forward. And the remaining here, we export profit reserve, investment allowance reserve, profit and loss account completely carry forward to the X Limited. So, what are the entries we recorded? So, what is the entry? Sundry assets, total assets, sundry liabilities, export reserve. First, general reserve of I Limited completely closed. And general reserve of X Limited, how much amount adjusted? 4 lakh 20,000. Next, other reserves, export profit reserve, investment allowance reserve, profit and loss, to business purchase. To business purchase. And next, payment, liquidator of Y Limited account debited to liquidator of Y Limited account debited to. So, what we, okay, so some entries missed here. And we have to write the entry what? Liquidator Y Limited account debited to equity share capital account to preference share capital account. To preference share capital. Equity share capital is how much? 35 lakhs. And the preference share capital is how much? 18 lakh 70,000. Preference share capital is also issued at premium. Discharged at premium, sorry, issued at par. Discharged at premium, but issued at par. So 18 lakh 70,000. 53 lakh 70,000. That is the entry. Okay, you have to write that one. And these are the already written. So liquidator of I Limited account debited to equity share capital to preference share capital. And these are the entries recorded in the books of X Limited as a part of the measure. and here the balance sheet. Okay, so just go through the balance sheet, but don't forget to give the adjustment of our general reserve. If you observe here, general reserve for X limited, Y limited, but this one completely abolished. 6,70,000 we have the difference between PC minus share capital, that is adjusted, and the remaining all are added together on line by line basis, just what we followed in consolidation, same thing followed here. Okay, and share capital is required to be increased accordingly. So here 33,50,000 shares, equity shares are issued, and around 18,700 preference shares are issued. Okay, and the remaining everything is added on line by line basis. But in case of amalgamation in the nature of purchase, and here also PC here is nothing but what, 53,70,000. But in case of amalgamation in the nature of my purchase, PC is compared with what, net assets. PC is compared with what, net assets. So here is the working, and net assets of file limited. So sundry assets minus debentures, trade payables, other current liability. How much? 57 lakh 50. And here PC we computed 53 lakh 70. So PC 53 lakh 70,000, and net assets we computed we have 57 lakh 50, and there is a negative figure of 3 lakh 80,000, and negative means capital profit, and is transferred to what, capital reserve. Transferred to what, capital reserve. And what is the entry? Business purchase to liquidator common, and assets to liability to business purchase to capital reserve, to capital reserve, and liquidator. So and next entry is what? So liquidator, sorry, same, liquidator of Y limited account debited to equity share capital to preferential capital. And here debentures are converted, 13% preferential capital, 13% debentures to 13% debentures. Okay, and next we have to write the balance sheet. Okay, so here don't transfer. So first of all, reserves are not transferred, but except statutory reserve. What are the statutory reserves we have? Here export profit reserve is there, and another thing is investment allowance reserve. Those are the statutory reserves. The two reserves we have to consider. So here, what is the export profit reserve? So 2 lakhs, and the investment allowance reserve 1 lakh. The two reserves we have to incorporate it. And how to present it in the balance sheet? So export profit reserve and investment allowance reserve and amalgamation adjustment reserve, better to reduce it from total of the reserves and surplus. Total of the reserves and surplus. In export profit reserve, 200 is added. Investment allowance reserve, 100 is added. And the 300 reduced in the form of amalgamation adjustment reserve. And here accordingly 18,700 preferentials increase, 3,50,000 equity shares are increased. The remaining asterisk we have to add each and everything on line by line basis. Okay, and the first important core part is PC. Amalgamation in the nature of measure, compare PC with share capital of transferor company. But in case of purchase, PC is compared with net assets of transferor company. So, and the difference we have to adjust as per pooling of interest method, as per purchase method. Then, coming to the eighth problem. Next, Super Express and Fast Express Limited were in competing business. They decided to form a new company, Super Fast, and these two are amalgamated together. And so here the balance sheets are provided, and assets and liabilities of both companies were taken over by the new company at their book value. And the companies were allotted equity shares of 100 each in lieu of purchase consideration amounting to 30,000, and 20,000 for Superfast Express and 10,000 for Fast Express Limited. And prepare opening balance sheet of Superfast, and considering what, pooling of interest method. Pooling of interest method. Here purchase consideration was already stated, already mentioned. So first of all, in case of pooling of interest method, we have to transfer each and everything on line by line basis. Each and everything on line by line basis. So coming to the line by line basis. And at the same time, PC is compared with what, share capital. In case of sorry, Superfast Express Limited and Fast Express Limited. Superfast Express and Fast Express Limited. So, okay. So PC is how much? 20,000 and 10,000 into 100 into 100. What is the share capital? Same. Share capital is how much? Same thing. So 20,000, same thing. So 20 lakhs, 10 lakhs. And the difference is 0. No difference is there. And no need to give the adjustment of amalgamation relating to the pooling of interest method. And just we added each and everything on line by line basis. So equity share capital. In case of equity share capital, so total 30,000 equity shares of rupees 100 each. So 30 lakhs. And in case of reserves and surplus, as it is a pooling of interest method, and all reserves and surplus are required to be added on line by line basis. So 1 lakh 60,000 and 1 lakh and 1 lakh and so total 3 lakh 60,000 and liabilities. So total added together land and building. So 16 lakhs and here 9 lakhs. Each and everything we have to add it on one by one basis. Okay. So here 3 lakh 60 and provident fund and buildings we have to add it on line by line basis and intangible asset is there and balances. Every asset and liability simply added together and actually there is no adjustment of amalgamation and that is very simple. Okay. And this is what in the books of transferee company we discussed as per AS14. But in the books of transferor company, nothing but vendor. Remember, AS14 is not applied. Simply we write dissolution entries in the books of transferor. In the books of transferor. What are the entries to be recorded? And for closing the books, we have to write the entries for closing the books of transferor company. What are the entries? First, so for closing the books of account, simply here we open one account called as realization account to close the assets and liability. All assets are closed by transfer to realization account. All liabilities are closed by transfer to realization account. And any realization expenses we paid through it. And PC we received, we transferred to realization account only. Just so assets are closed by transfer to realization account at what price? Book value. Whether it was taken or not, everything is transferred to realization account. All liabilities are realization account divided to what? Assets. And all liabilities are closed by transfer to realization account at book value. Liability generally having credit balance. Then for closing it, we have to debit liabilities account debited to realization. For realization expenses paid, realization expenses paid. We write the entry realization account debited to cash if it was paid by transfer or if it is paid by transferee, nothing but purchasing company, realization account debited to purchasing company account. And for PC due, when we PC receivable from whom? Purchase company, transferee company. So transferee company account debited to realization because we are getting the PC in return for transferring the assets and liability. All assets and liabilities are already transferred to realization. That's why PC is also required to be transferred to realization. But receivable from transferee company. That's why we write transferee company account debited to realization. And the PC received, cash or bank, equity shares of purchasing company, preference shares of purchasing company, debentures of purchasing company to the purchasing company or transferee company account. And for transferring the due to the preference shareholder. Preference shareholders account debited. Preference shareholders means preference share capital account debited to preference shareholder. For example, if the preference shareholders are discharged at a premium, then preference share capital account debited premium on preference shares to preference shareholders and but the premium whatever the excess we paid to the preference shareholder is a transfer to realization account only. Okay, anything. So first we transfer preference share capital, but coming to the settlement, any difference we have for payment to the PC to the preference shareholder, two bank, two cash, two equity share, two preference share, two debentures, etc. But any difference we have in preference shareholder, just we transfer to realization account. And that's why if any preference shares we have, realization account is closed after settlement of PC to the preference shareholder. After settlement of PC to the preference shareholder. Next, for transferring due to equity shareholder, equity share capital, reserves and surplus, both will transfer to equity shareholder. But while transferring the PC, so while adjust settlement of PC, first we have to adjust realization profit or loss. Any profit realization account debited to equity shareholder. Any loss, equity shareholder account debited to realization account. And finally, for settlement of PC, equity shareholder account debited to cash, to bank, two equity shares of purchasing company, two preference shares of purchasing company, two debentures of purchasing company, etc. And this is about what? Journal entries relating to transferee company in the books of, sorry, journal entries relating to the transferor, relating to what? Transferor in relation to amalgamation. Okay, yes. And here, the following are the balance sheets of S Limited and No Limited. And here, so two balance sheets are provided and notes to accounts are provided. On the day, S Limited absorbed Y Limited, absorbed No Limited. The members of No Limited are to get one equity share of S Limited at premium of 2 per share for every 5 equity shares held by them in No Limited. For every 5 equity shares held by them in No Limited. What are the equity shares of No Limited? 5 lakhs. So amount is given in terms of what? 5 crore. 5 crore by 10. 50 lakh. So 50 lakh equity shares are there in No Limited. What is the PC here? For every 5 equity shares held by them in No Limited, they are getting one equity share. Each one is getting a 2 rupee premium. So into 1 by 5. Nothing but what? 10 lakhs into 12. Nominal value 10, premium 2. So 1 crore 20 lakhs. So this is about what? PC. 1 crore 20 lakh is the PC. So, and 1 crore 20 lakh is the PC. And the necessary approvals are obtained. What are the journal entries in the books of 2 companies? What are the entries we recorded? First, so all assets and liabilities we transfer. First, for transferring the assets, realization account debited to property, plant and equipment account. If any bifurcation we have, we need to provide. Realization account debited to PPE. First, we transfer the gross value, and provision for depreciation we have to transfer in the form of liability. In the form of liability. So how to transfer realization account debited to PPE 30 crore and provision for depreciation account debited to realization account 24. Okay, and other assets also required to be transferred. Realization account debited to current assets, if any, so 34. And after that we have to transfer liabilities. So current liability account debited to realization and long term borrowings account debited to realization. And after that we have to write the PC. So YS limited account debited to S limited account debited to realization. What is the PC? 1 crore 20 lakhs. 1 crore 20 lakhs. And then we move on to the, so equity share capital transfer to equity shareholder. Equity share capital account debited to equity shareholders account. And after that we have to close the realization account. Whatever the realization profit is, that is transferred to equity shareholders only. And finally, whatever the PC we receive, PC received in terms of equity shares of S limited account debited to, so S limited account. And after that, equity shareholders account debited to equity shares of S limited. Once we settle the PC to the equity shareholder, all accounts have to be closed. Okay, and coming to the, there is a long term loan to No Limited, but remember this intercorporate owings or stock reserve, these all treatments we have to consider in the books of transferee, not in the books of transferor at all. And also we have to write the entries in the books of S Limited. S Limited is a transferee company. In the books of transfer, what are the entries to be recorded? First, business purchase account debited to liquidator of No Limited, 1 crore 20 lakh. And the second one is incorporation of assets. Assets account debited, PPE account debited 30 crore. So, and current assets account debited, two provision for depreciation 24 crore, two current liabilities, two long-term borrowings. So, two long-term borrowings, nothing but unsecured loan from S Limited. And after that, two business purchase account, 1 crore 20 lakh. 1 crore 20 lakh. But here, there is a difference between PC and net assets. PC and what? Net asset. What is the difference? What is the net assets here? Net assets are how much? So total assets are 40 crore and total liability is 25. 40 minus 25. Nothing but what? 15 to. 1 minute. 40 minus 15. So how much amount? 15 crore. This is the net asset. But what is the PC there? 1 crore 20 lakhs. 1 crore 20 lakhs. So here PC is 1 crore 20 lakh. Net assets is 15. And the difference is 13.8. 13.8. PC is less. So negative. So it is a capital reserve. And what is the entry to be recorded? So first PPE account debited. PP account debited 30 and current assets account debited. So how much amount is that? 34. 2. Provision for depreciation 24. 2. Current liabilities. How much? 15. 2. Long term borrowings 10. 2. Business purchase 1.2. 2. Capital reserve 13.8 crore. 2. Capital reserve 13.8 crore. This is the entry to be recorded. Okay. So because the method is not mentioned. Oh, sorry. And here it was mentioned it as amalgamation in the nature of measure. In case of amalgamation in the nature of measure, we have to, we have to compare what? PC with share capital. What is the share capital here? 5 crore. PC 1 crore 20 lakhs. Share capital 5 crore. And the difference is 3.8 crore negative. So it is also transferred to capital reserve. It is also transferred to what? Capital reserve. But here we have to transfer all assets and liabilities, including reserves and surplus. What is the entry to be recorded? PP account debited. So PP account debited and current assets account debited. 2 provision for depreciation. 2 current liability. 2 long-term borrowings. 2 reserves and surplus. 2 reserves and surplus. 2 business purchase. 1.2. 2 capital reserve. How much amount is that? 3.8 crore. 3.8 crore. Okay. So only the difference here is if it is a purchase, reserves and surplus are not transferred. If it is a major, reserves and surplus is transferred. And the difference is nothing but what? Simply nothing but reserves and surplus. Okay. So these are the entries in the books of transferor and in the books of transfer. Next, coming to the problem. The following are the summarized balance sheets of B Limited and G Limited, and the data was provided. Okay, and notes to accounts was given. And B Limited absorbed the business of G Limited. For every equity share held by equity shareholders of G Limited, they receive 10 rupee in cash. 10 rupee in cash. First of all, how many equity shares held by G Limited? G Limited held so 100 rupee each means 11,500. And the preference shares are nothing but 2,700. These are the equity shares and preference shares held. So here, so 11,500, right? 11,500 into 10 into 10 and 1 equity shares of 100 each. So 11 lakh 50,000 and 10% debenture holders of G Limited were to be allotted with 9% debentures of 100 each in B Limited, as would bring same amount of interest. This is very important. Same amount of interest. And first of all, coming to here, 10% debentures of G Limited is how much? 10% debentures of G Limited. So 1,80,000 into 10%. What is the return they are getting? 18,000. And this 18,000 is equated with 9%. Then 18,000 by 9%. This is what? 2 lakhs. This is the 2 lakhs amount is nothing but debentures issued to them. 2 lakhs is nothing but what? Debentures issued to them. So here 2 lakhs issued debentures issued to them. Okay. And another one. And what is the amount payable to the equity shareholder? So 1 lakh 15 and 11 lakh 50. And this is the one. And next, preference shareholder. 10% preference shareholders of G Limited are to be paid at 15% premium by issuing 9% preference shares of 100 each in B Limited in such a way that existing dividend quantum of the preference shareholders of G Limited will not be affected. So we have to settle it what? 15% premium. 15% premium. So what is the 9% preference share? Sorry, what is the 10% preference shares of G Limited? What is the preference share, sir? 2,700 into 2,000, 2,70,000 into 10%. So here, so 2,70,000 into 10%. How much? 27,000. 27,000. And what it says, the preference shareholders of G Limited are to be paid at 15% premium. Are to be paid at 15% premium. So nothing but 2,70,000 plus 15%. 40,500 plus 2,70,000. 3,10,500. 3,10,500. And 3,10,500. And one more condition, by issue of 9% preference shares of 100 each. By issue of 9% preference shares of 100 each in B Limited in such a way that the existing dividend quantum of the preference shareholders of G Limited will not be affected. Existing dividend quantum. What is the dividend they are getting now? 27,000. What is the dividend they are getting now? 27,000. So 27,000. Okay. 27,000 by what are the preferences we are issuing? 9% preferences. And how many preferences are we are issuing? So 27,000 by 0.09. Nothing but what? 3 lakhs. Nothing but what? 3 lakh. So 3 lakh amount we are giving. 3 lakh amount. Okay. So remember. So first condition is 27,000 by 9%, 3 lakhs. But 15% premium we are redeeming. And total amount we have to pay 3,10,500. But out of that, at par we are issuing 3 lakh only. The remaining amount 10,500 is issued in the form of what? Premium. In the form of what? Premium. So here the total amount we require to pay 3,10,500. How much? How to? 2,70,000 plus 15%. But they need to get the same amount of dividend what they get previously. So they are getting the what? So 2,700 into 100 into 10%. 2,27,000 is the dividend. 27,000. 27,000 equated with 9%. Then at 100 they are getting 3 lakh. And the 3 lakh by 100 rupee per share. 3,000 share. 3,000 into 100. And the difference amount. What is the total amount? We agreed to pay 3,10,500. And the difference 10,500 is treated as premium. Premium. So here 12 lakh 65. Here 3 lakh 10,500. Total 15 lakh 75,000 is what? PC. And next one. A contingent liability of G Limited amounted to 70,000, 72,000 is treated as actual liability in trade payable. This is required to be added as an unrecorded liability. Expense of liquidation of G Limited are reimbursed by B Limited. So reimbursed by what? B Limited. B Limited reimbursed it. Inventory of G Limited taken over at 10% more than their book value. And debtors of B Limited include 51,400 receivable from G Limited. This is what? Intercorporate owings. And PPE of G Limited valued at 20% above the book value. And the remaining assets and liabilities are taken at same value. And what is the nature? The nature is not specified. We have to consider it as amalgamation in the nature of purchase. Already revaluation was provided, so it is a purchase only. So in case of purchase, what are the entries to be recorded and what is the balance sheet? And journal entries to be recorded in the books of B Limited. B Limited means what? So transferee company. In the books of transferee company, first entry is nothing but business purchase account debited to. First we compute what is the PC. Okay. First entry, business purchase account debited to liquidator of G Limited. Okay. Second entry is incorporation of assets and liability. And remember, while incorporating it, all assets and liabilities, including any unrecorded assets we identified, those are also required to be considered. If not, if those are also considered by transferee company. So PPE account debited, inventory PP is added by 20%, revalued up by 20%, inventory, trade receivables, goodwill, no goodwill, two 10% debentures, two loan from bank, short term borrowing, 72,000 is contingent liability, two business purchase, the difference amount is treated as what? Goodwill. PC is compared with net assets and difference amount is treated as what? Goodwill. And if any difference we have on credit side, consider it as capital reserve in case of purchase method only. And a liquidator. Liquidator of G Limited, 2 share capital, 2 preference share capital, 2 premium. Premium is nothing but 10,500. Total amount payable to preference shareholder, 3,10,500. And remaining, and initially, so so 1,15,000 we also paid in cash. So 2 cash. And we converted debentures, 10% debentures to 9% debentures. And at the same time, this is what amalgamation in the nature of a purchase. In case of amalgamation in the nature of purchase, any liquidation expenses we paid it as goodwill account debited to bank or capital reserve account debited to bank. There is no capital reserve, we adjusted to goodwill. And intercorporate owings, trade payables to trade receivables. Okay. And we have to prepare what? Balance sheet. And next, coming to the 11th one. The following is summarized balance sheet of Blue Limited and Yellow Limited. And here is the balance sheet and its data was given. On 31st March, Blue Limited absorbed business of Yellow Limited on the following term. 8% debenture holders of Yellow Limited are to be paid at 10% discount by issue of 10% debentures at par. By issue of 10% debentures at par. So, but this is the amount payable to debenture holder. But what is the amount they agreed to pay? What is the debentures of Yellow Limited? So, how much? 8 lakhs. Debentures of Yellow Limited is how much? 8 lakhs. So, and we are paying what? 8 lakhs minus 10%. 7,20,000 by issue of 10% debentures. So, while converting it, 8% debentures to 10% debentures, 8 lakh, 7 lakh 20, and the difference is 80,000 transferred to capital reserve. We transferred to capital reserve in the books of what? Blue Limited. In the books of Blue Limited, transferee company. And there is unrecorded current assets 1,16,000 in the books of Yellow Limited, which is taken over by Blue Limited. Okay. And trade payables of Yellow Limited include 4,50,000 payable to Blue Limited. This is what inter-corporate owings. Inventory of Yellow Limited taken over by Blue Limited 10% more than its book value. Remember, any unsold stock we have, we need to eliminate stock reserve. Goodwill, and this is important. And goodwill of Yellow Limited on absorption is to be computed based on 2 times of simple average profits of preceding 3 financial years. So 2021, 22, 22, 23, 23, 24. 22, 23 there was an embezzlement of cash. But remember, while calculating the goodwill, we have to consider normal profits only. Any abnormal profit or abnormal losses we have required to be, those are not required to be considered. But already adjusted, required to be reversed. So here, 21 to 22, 4,50,000. 22 to 23, 3,90,000. 23 to 24, 2,35,000 was given. But in 22 to 23, embezzlement of cash. Embezzlement of cash means what? Loss. That was already adjusted in profit and loss of the 20 to 23. And it means there is a loss. Loss means the profit has been decreased. Now we have to reverse it because abnormal losses cannot be considered. But already considered, required to be reversed. So how much? 50,000 is required to be added. What is the total? So 4,50,000, 3,90,000, plus 50,000, 2,35,000 by 3, 4,50,000, 3,90,000 plus 50 plus 2,35,000 by 3. 3,75,000 is the average profit. What is the goodwill? So 2 times of simple average profit and 3,75,000 into 2. 7,50,000. This is what goodwill and is added in net assets. PPE are taken over by 36,44,000. Remaining assets are taken at book value. Equity shareholders of LO Limited will be issued necessary number of equity shares in Blue Limited at 5% premium. What is the PC? PC is calculated. There is no specific method. We follow the net assets method only. In case of net assets method, we have to consider what goodwill. First what? Goodwill. So here, what is the goodwill we computed? 7,50,000 and PPE that was given directly. Other as inventory. Inventory. There is no change in value of inventory. Sorry. Inventory taken over by 10% more than book value. And we have to consider it 110%. Trade receivables, cash in hand, cash at bank, unrecorded assets are also taken. And plus we have to reduce what liability. And the liabilities means 10% debentures are settled at 10% discount. That's why we consider 7,20,000. Other funds we have to consider. So this is what net assets. And what is the net assets here? So 13 lakh. So sorry, net assets 42 lakhs. And this is what PC. And this 42 lakh. So those are settled by issue of equivalent number of equity shares at 5% premium. What is the par value? 100 rupee. 5% premium is 105. 42 lakh by 105. 42 lakh by 105. Nothing but 40,000 equity shares are issued. So in this case, goodwill method is first important. Embezzlement cash is abnormal loss required to be reversed, and others are considered at book value. Unrecorded assets are given; those are also required to be considered. And no need to eliminate intercorporate owings because elimination is done in the books of transferring, not at the time of calculation of purchase consideration. Debentures agreed to discharge at 10% discount. That's why we reduced. Okay. And after that we have to prepare what balance sheet, and this is amalgamation in the nature of purchase because some revaluation is happened. So in that case, so in the books of transferee company, while preparing balance sheet, we have to compare PC with net asset, but here PC is also calculated by using net assets method only, correct? So there is no difference arised. So this is the PC, sorry, goodwill calculation. And the remaining how to prepare the balance sheet simply by adding each and everything except reserves and supplies cannot be considered unless there is a statutory reserve. Okay, next. The following is the balance sheet of Pickles Limited on 31st March. And okay, and balance sheet here was provided and notes to accounts was given, and this is important. And Food Limited acquires the business of Pickle Limited. And so Food Limited is the transferee, Pickle Limited is the transferor company. Food Limited take over all assets except cash. Cash is not taken. And the liabilities at their book value. All assets and liabilities at their book value. Part of the furniture and fixtures disposed of by Pickle Limited for 55,000 at cost. Part of the furniture so has been disposed at 55,000 at cost. Retirement of employee was due on 31st March. A portion of 35,000 for retirement gratuity fund was earmarked towards payment due to them. Towards payment due to them. That is shown as a part of liability. And Foods Limited decided to pay each preference share in Pickle Limited at 27 in cash. 8% preference shares of 100 each in Food Limited. And for each equity share in Pickle Limited, it was decided to pay 30 in cash and one equity share of Food Limited for 145 each. And liquidation expenses 22,500 paid by Pickle Limited were subsequently reimbursed by Food Limited. And fixed assets of Pickle Limited were not revalued for the purpose of amalgamation. Understood? So here, what is the amount payable to the preference shareholder? What is the amount payable to the equity shareholder? Clearly mentioned. How many equity shares we have? 6,000. How many preference shares we have? 5,000, right? So, in case preference shareholder, 5,000 into 27 in cash and 8% preferential. So, 5,000 into 100, 8% preferential. So, this is the one. And here, equity shares are how many? 6,000. So, 6,000 into 30 and one equity share 6,000 into 145. 145. This is what PC. Just let's verify. So here is cash and 5,000 differentials into 10. So 100 and 6,000 into 30, 6,000 into 145. This is what purchase consideration. Okay. First point is over. And what is the second point? So first we have to write the journal, past necessary journal entries, also prepare realization account, cash account in the books of PK Limited. Journal entries in the books of PK Limited. PK Limited is a transferor. So we have to write closing entries. All assets are closed by transfer to realization. So realization account debited to all assets. All assets we recorded at book value. And all liabilities are transferred to realization. So realization account debited to, liabilities account debited to realization account at their book value. At their book value. But in case of retirement gratuity fund, 60,000 is there. But out of that, 35,000 is only transferred. Because 35,000 is only considered as a amount due to them. Amount due to them is considered as 35,000 because that amount is only liable on 31st March. So that is only we transfer. And next, so we sold one furniture, 55,000 worth of the furniture, cash account debited to realization because furniture already transferred to realization. So cash account debited to realization. And when the, so for PC receivable, so Foods Limited account debited to realization. And when the PC received cash account debited, equity shares of Food Limited account debited, preference shares of Foods Limited account debited to realize Foods Limited account. So we have to settle to the preference shareholder, settle to the equity shareholder. Before settling to the equity shareholder, and we have to calculate realization profit or realization loss. We have to adjust. And this is what realization account and cash account. And most important thing was PC. Most important thing PC. In case of measure, PC is compared with share capital. In case of purchase, PC is compared with net assets of a transfer or company. And based on that, we have to prepare. And the remaining everything is simple. And if you do the PC correct way, then the remaining is simply a process. Okay, this is what amalgamation. So total amalgamation in the nature of measure and purchase in the books of transferee company and journal entries in the books of transferor company. How to prepare financial statements. This is the topic. Only three topics covered in amalgamation: PC, accounting entries in the books of transferor, accounting entries in the books of transferee. Okay, I hope you enjoy the class. And if you like the video, don't forget to press the like button and also share it to your friends and don't forget to subscribe. Okay, thank you. If you have any doubts, please comment below the video in the channel, or you may join my Telegram channel. Through that, you may ask any doubts if you have. Thank you. Bye bye. Take care.